many time zones. So I'll give a quick intro on myself. I've been in Silicon Valley for 20 years now, just over 20. I came here for college. I went to Stanford, did my undergrad and master's there. Went to Google after that, worked as a PM. This is early days at Google before it was this massive corporation. When I was there, it was still a smaller company of less than 1,000 people. And after that, went to business school, came back to Silicon Valley, and joined venture capital. And that was the first of the venture capital funds that I worked for. It's a very large fund called Norvus Ventures. It's today a 10 billion assets under management. And I was investing multi-stage, especially focused on early stage when I was there. Then I started my own company called HealthIQ, which has gone on to raise 120 million in venture capital. I'm happy to share that journey. Then went back into venture capital, joined another firm doing early stage, based out of here, Silicon Valley, and now have started my own fund called Tau Ventures, which is about a year old. My partner and I used to work together at Norwest and stayed in touch for almost 10 years and planning really on the right time, both personally and professionally, to start this fund. We are seed focused. We invest in applied AI in 3 verticals: digital health, enterprise, and automation. We define digital health as all the way from computer vision for detecting colon cancer to using machine learning for detecting biomarkers. You can develop antibodies. One of our portfolio companies just announced 2 hours ago a Series A of 10 million. It's focused on cancer for dogs. Enterprise for us includes cybersecurity and tooling, and automation is our catch-all for robots, self-driving cars. We have done a bunch of investments in food automation. Our portfolio is all online. It's tauventures.com, 14 investments so far. We put in about 250 to 500K through the fund, and we focus right now in US and Canada. So we need entrepreneurs to be based here, the market to be here. That's just a question of resources. There's great entrepreneurs all over the world. We are just not focused on them yet. So with that said, let me move over here to Denise's title of the question: what is venture capital and how does it work? Debatable whether it works, but let's leave that joke aside. And I want to make this as much of a dialogue as possible. We have just about 35 people in the room here, in the virtual room. What I've done in previous events is any questions, put it in the chat. I'll incorporate here, and I'll move from topic to topic. I want to make this as useful and productive for you, for the audience. So let me start with what is venture capital. So venture capital is both new and not new. Venture capital in many ways has existed since ancient times, because you would extend credit to someone for their business or whatever project they have, and in return they would, once they succeed, give it back to you with interest, right? But in its modern form, venture capital is maybe about 40, 50 years old. And the notion of carry is something that has really gotten formalized in the last, call it 50 years. Carry is just the term used in our industry for a percentage of the profits that the venture capitalist, the investor, actually accrues. So a 20% carry means if I make an investment, once that investment succeeds, gets sold, let's say, 80% of the profits that I would have made go to my own investors, which is called LPs, and 20% go to me, to the investor, which in our industry is known as a GP. So let me clarify that once again. A GP, or a general partner, runs a venture capital fund. An LP, or a limited partner, are the investors in a venture capital fund. Every venture capital fund has got investors behind them. In some cases, one investor. Norvus Ventures, the fund I used to work for, is maybe the largest single investor fund out there. It's a very small bank known as Wells Fargo that you may have heard of. And that is actually atypical. Most venture funds have multiple LPs, including my own. I have many, many LPs out there, which include individuals, include family offices, include even a law firm, an institution. And sometimes they include endowments and pension funds and universities and corporates. I mean, a variety of folks can be LPs in a venture capital fund. And when a venture capital fund says, I have $100 million, what they're saying is, I have the capacity to deploy $100 million. I don't have $100 million today. I will ask my own LPs to send money in, and over the course of time, I will be deploying $100 million. Typically, most VC funds operate with a length of 10 years. So a $100 million fund will be deploying that $100 million over 10 years. And they will keep a portion for new investments, call it 50%. That's typical in the industry, and 50% for follow-ons. What they're basically saying is, I will put in 50 million of that money in this particular example whenever I make a new investment, and 50 million I'll keep in reserve so that when my companies actually raise their next round and their next round, I'll be able to put more money to work. So a good rule of thumb that I have is, a fund typically puts in about 1% on average of their entire fund size into a new check. So a $100 million fund will be looking to put in about a $1 million check to start with. Could be a little higher, could be a little lower. There are people with different strategies. Some people have the strategy of, let me write a lot of checks and don't spend as much time with my entrepreneurs. And some people have the other strategy, let me write very few checks and spend a lot of time with my entrepreneurs. On average, call it 1% of the fund in an average check. So if you're an entrepreneur raising money, and let's say you're raising 1 million, chances are you want to talk to funds that are up to $100 million. Any fund that's larger than that, if they write a check to you, what they're doing essentially is giving you some money and not as much of their time, with the expectation that when you do raise more money, they will come in and actually write a bigger check. They're basically buying an option value in you. So let me take a pause here. I shared a lot of different concepts here. I want to make sure all of that made sense. I'll wait for a few seconds to see if there are a few questions. Otherwise, I'll open up another topic. All right, I must have explained everything really well, or I'm very boring. I'll choose the first option. I have had no questions. Going once, going twice. Sold to myself. I will continue on another topic then. So let's talk about the different stages of fundraising. A lot of folks are get confused, understandably, about what is a seed, what is a Series A, what's a Series B, and used to be 20 years ago that a 5 million was a very large Series A. Nowadays, a 5 million is borderline a seed. And if you are in Thailand, you might say, okay, $1 million is good. But if you are in New York City, maybe $1 million is not enough because of the cost of living, the differences. So how do you think about it? Well, let's go back to definitions. A pre-seed, which is sort of a new concept, is you have a PowerPoint. You probably 2 or 3 people with a PowerPoint. There's nothing more than that. A seed is you have a prototype. You have something to show. It may not be working fully. It may not be a minimal viable product, MVP, but there's something here. A pilot, in my view, is a mature seed. So you're saying, look, I have something, and I already have somebody who is working with this something. I have a pilot. It may be paid. It may be just a 6-month test, a 1-month test, but there's something here. A product market fit is the Series A. At that point, I'm signaling to the market that, look, it's not the amount of money I'm raising, it's what I'm using the money for. I have product market fit, or I'm very close to getting product market fit, meaning I have multiple users or multiple customers, some of which may be paying, ideally, some of which are paying. And a Series B is your business model is starting to scale. So once again, it's not how much you raise, it's what you use that money for. You may very well see a 1 million seed, a 1 million pre-seed, a 1 million Series A. I've not seen a 1 million Series B, but I'm sure it's possible. It's what the entrepreneur uses the money for. And I'll tackle the question right after finishing this point. There are certain guidelines associated with the different rounds. So Silicon Valley sort of sets the trend of how things are being done in at least the US. And many other parts of the world kind of look up to how the trends are being set in the US. But about a 20 to 30% dilution in your seed is the norm. So if you are raising 2 million, chances are that an investor is thinking, okay, this person is probably looking for somewhere between 8 to 10 million post, meaning that 2 million is going to be, in the case of 8 million, 25%, or in the case of 10 million, 20% of the value of that company. So 20 to 30% is pretty standard in the seed. 20 to 30% is also pretty standard in the A. 15 to 20% is the standard in the B, and then it starts going down, 10 to 15 in the Series C, and so on. And at the pre-seed, what has become more and more common in Silicon Valley is you say, I don't know how much this is worth. I'm just going to set up a convertible note, meaning a loan that will convert into an ownership into the company based on certain parameters once we decide on what the value of the company is. I'm basically punting the question further ahead on how much my company is worth. That has become very standard in Silicon Valley. It's not as standard in many other parts of the world, but it's increasingly becoming so. So let me take a pause here. Let me take a few questions. Somebody asked here, Yuichiro, 1% allocation of total fund size for check size normal, maybe depending on a target stage. Yeah, that 1% that I gave you is a rule of thumb based on my empirical data of having raised money and of deploying money. There is nobody out there that will tell you it's 1%. It's what I've seen that most people do. What funds will tend to do, what this actually is that funds will have ownership quotas. So Yuichiro asked, maybe depending on a target stage, many funds will say, I need to have X% in the Series A. And if I'm leading the Series A, that X is often somewhere between 15 to 20%. So the fund is saying, look, I want a big position in the company. And given that if you do the math, it comes out to that roughly that 1% that I'm talking about. But the real metric is ownership. If you are a lead investor means you are setting the terms of the round. A lead investor is often the largest investor in the round, but the definition is you're setting the terms of the round. A follow investor, conversely, is somebody who is accepting the terms that have been set and joining that round. We at Tau Ventures, incidentally, are happy being leads or follows. You'll find that many funds are either leads or follows, or preferentially leads or follows. We are preferentially a follow fund just because we're not a huge fund yet, so we cannot come in with very large check sizes and set the terms. But you'll find some very large funds who actually take a follow strategy that is dependent on what the fund wants to do. So, oh boy, I must be getting either very confusing or very interesting, one of the two, because there is multiple questions here. So let me go over to the next question. Yuichiro, hopefully I answered your question. And let me go over to Sanjay Sharma's question. Can you explain convertible notes one more time? Sure. So there's a lot published online about convertible notes. I encourage you to also look into them. I've written a bunch of articles on it. I have a blog that I focus on one-page articles, so you can read it in 2 minutes on your phone while you're waiting for your food to get heated in the microwave. But a convertible note is an emphasis here on note, which means it's a debt, and convertible means it's a debt that will get converted into equity. Equity is shares in the company, it's ownership. A convertible note is a loan. And what I'm saying is, typically there's a valuation, a cap, I mean. So let's say it's a convertible note with a 10 million cap and a 20% discount. What I'm essentially saying is, look, I don't know how much this company is worth, but I think that at the next round, they'll be worth at least 10 million. That's the cap. That's the notion of the cap. Um, if they don't hit that 10 million, I'll get converted based on a discount rate. If they do get the 10 million, I'll just get converted on a straight line. It gets a little complicated to do this math, and it's maybe a little too much to talk about it in this forum. But essentially, what I hope I can share today is that you want to give some kind of benefit to the investor for taking a risk right now, and the cap and the discount are ways of incentivizing that investor. You set a certain limit up to which the investor will get a benefit, and the discount rate is that benefit. So a convertible note, a loan, will get converted on shares based on these two parameters. The other parameters are maturity date and interest rate, just like any other loan instrument. So I'm saying if I don't hit a next round that is a priced round, let's say within 18 months, then you will get automatically converted into shares in the company. So that is, the maturity date is 18 months. And by the way, there's going to be an interest rate. The interest rate rarely matters. It's usually like 5% or 10%, something like that. But it's a little bit of it, just like giving any loan, it's a little bit of a bonus you're giving to the investor. But 99.9% of investors will tell you what they really care when they're giving you a convertible note is the cap and the valuation and maybe the maturity date. The interest rate doesn't matter that much. So I hope that made sense. I know it's a lot to cover in a couple of minutes around convertible notes. I encourage Sanjay and anybody else who's interested to Google up this a little bit or just go onto my blog. I describe this in a lot more depth. So Peter Stone is asking, are safes taking over from convertible notes? So let me explain the notion of safes to get everybody here on the same page. A safes is a type of convertible note. The nice thing about a safe is that it is a very easy instrument, and it allows you to continue raising based on that particular safe rather than creating multiple notes. It basically means I'm raising money, it's going to be open forever, here are the terms, and the only thing you negotiate with the investor is the cap and the discount rate. And maybe you don't even negotiate that. You could actually set that. So it's super simple. It keeps your legal costs low. That said, let me give you the flip side. I actually wrote an article about this 2 weeks ago. Safe notes are great as long as you do them safely, because you could actually be very unsafe with a safe note. The safe gives you the false conviction that you could just continue raising money. And if you just continue raising money, at some point when it all converts, you'll get diluted a lot. So as an entrepreneur, you should not continue raising safes forever. You should be careful. Also, investors, they kind of don't like safes, to be honest, because it is more risky. You're not giving them any kind of milestone, and you usually set terms that are much better for you as an entrepreneur. So look, I feel very comfortable investing in a safe. I've done safes myself on both sides of the coin here. But if you go to ecosystems that are perhaps less developed, you'll find that investors will resist a lot more the safes. And even within Silicon Valley or New York or London or Bangalore, which are very mature ecosystems, you will find that investors will have mixed reactions around safes. So safes are slowly but surely taking over from convertibles at the very, very early stage, at the pre-seed stage. I think at the seed stage, convertibles are still the norm. And in fact, price rounds, I see a lot of price rounds at the seed stage also. There are benefits to doing a price round at the seed. It gives a lot more stability, and it allows investors to be more vested in your success. So short answer, yes, safes are becoming far more common at the pre-seed. So let me go over to the next question here. Linda Sharp has a question. Instead of convertible notes in pre-seed, how about safe agreements? Well, what do you think? I guess I just answered that. Yes, I think that is becoming the norm. I think it will become the norm worldwide because the pre-seed is so early. You barely know anything. It's usually 2 or 3 people with an idea. I do think the safes make a lot of sense. The safes are not the only instrument like this, by the way. There have been other attempts at creating very simple convertible notes. Safes have just become very popular, uh, partly because of Y Combinator. Y Combinator really defined what safes are, I think about 5 years ago, 5 or 6 years ago. So that is why they've become so prevalent. But there are other simpler instruments out there. I've seen a few other funds try to promote their own version of a very simple agreement. So let me take a pause, make sure all of this made sense. If anybody has different questions or follow-ups, please chime in. And I do get one. So Max is asking, would you be able to share where to find your articles? Yes, indeed. I get to do propaganda. Why not? So you can go to my LinkedIn. And if you want to see all my articles, you can just go to my feed. So I will send that link out. Give me 1 second. I am sending here, just scrolling down. Boom, here. This is all my posts. Chat. Oh, and while you're at it, I am in many ways a startup myself, running my own venture fund. So I will be grateful for anybody who wants to give a like on Tau Ventures on LinkedIn or Facebook or Instagram or Twitter, whatever you want. But if you want to give me a like, I appreciate it. It helps us. So I see Peter is asking, I see many entrepreneurs staying with safes for too long. I'm going to read what you wrote in Raw. Well, thank you, Peter. And yes, entrepreneurs staying with safes for too long is not safe. It's no pun intended. No, sorry, pun is intended. I think there are many benefits of safes, but just like anything else you do with a startup, you can go overboard. If you leave safes open for too long, it signals to the market that maybe you're not getting there in terms of the next round. And then you end up diluting yourself also. So be very careful. And thank you, Denise. That's very kind of you. I appreciate it. I can move on unless anybody else has any thoughts, questions. The meaning of life. It's 42, by the way. All right, so let's go back to another regularly scheduled topic. So let's talk about VC funds. VCs come in many size, shapes, and forms. VC as an industry has really matured and keeps changing. What was true 10 years ago is no longer true, all of it true today. There are principles that are true, but not necessarily specifics. And there are now distinctions of VCs in terms of size of fund. There's something called micro VCs, small VCs, medium VCs, large VCs. I've even heard the term nano VCs. I have an article about this too for those that are interested. But these are rough metrics for how big your fund is. And today I would argue that if you're under 50 million, you're a micro VC. If you are up to, call it 150 million, you're a small VC. If you're up to 300, 400, you're a medium VC. And then you have large VCs. And large VCs tend to be multi-stage, so they're investing in seed, Series A, Series B, all the way up to E, G, F, whatever. And multi-stage funds tend to write larger checks because what is the limiting factor for any VC is their time. Realistically, a person can only be involved with maybe 10 companies. If they are involved with more companies than that, then they are not devoting as much time to their investments. And that is a valid strategy that some VC funds use. But I think 10 is the ideal number. So if you look at a VC fund and you look at the particular partner that you might be interacting with, and that particular partner has already 8 boards, chances are that they are not looking to do that many new deals. So I encourage anybody seeking funding, whether it's the very first institutional round or a much more later stage round, is do your homework. Like spend 10 minutes just looking up the persons that you might be working with, the fund that you might be working with, and then ask them very pointed questions. Ask them, how many boards are you on? Because I saw on the website that you're already involved with 6 companies. Do you really have the time to devote to me? And if not, that's fine, but I want to make sure expectations are clear. How many times have you followed up on your portfolio companies? Because there are VCs who play the strategy of, I will always write a check in a company I've invested in future rounds. And there are VCs who will say, I will barely write checks. Hint, a early stage fund tends to do early stage, and they will at some point not write checks in the series B or C or D. And a late stage fund will write a small check with the idea of just waiting to see when you are much further ahead to write a really big check. So this interplay of size and when you come in, like those are pointed questions that you should be asking any VC you interact with. And you can always look them up on Crunchbase. Crunchbase is incomplete and sometimes incorrect, but it's pretty good directionally, pretty good about giving you a good picture of when a VC invested, how they invested, what check size they might have invested, and it will give you a true sense of what a VC actually does. Because if you ask most investors, they will tell you, yeah, of course, we like good entrepreneurs and we like investing in them and we look at everything, but you want to see whether they follow up on in actions what they say in words. They might say, yes, we take bets into disruptive entrepreneurs. Well, what does that really mean? I mean, sure, disruptive entrepreneurs, that tells you no real information, right? If you want to ask them, have you ever invested in a first-time entrepreneur? Well, look up at their track record. Look up at the companies they've invested in, right? So I encourage all entrepreneurs to do as much diligence on their investor as much as the investor does diligence on them. I like entrepreneurs who do diligence on me, because I haven't been an entrepreneur myself. I did my diligence when I was signing up with an investor. It tells me that they're being careful about who they bring on board. It tells me the way that they operate, that they do their research, that they are being thoughtful about it. And I look at VC as essentially a marriage. And it's actually the VC is an owner in your company. It's a partner, and it's hard to hire and fire an employee. It's even harder to fire and hire a VC. If you and a VC don't get along well, it's very hard to get rid of them. There's literally only 2 ways. One is you force them to sell their shares to some other investor, or you get the entire board to neutralize them. I mean, it's very complicated, and I think it's better for you to start with the right foot and work on having a really good relationship with your investor. And another analogy I have is the coach versus the player. The CEO, the founders of a company are the players. The job of the VC is to be the coach, to enable them to succeed, not to run the company. We are not running companies. We are company builders, but you are the captain of the ship. So when you're doing diligence on a VC, see if all of this resonates with you and what they are saying resonates with you, and sign up with them carefully. There's some fantastic VCs out there, and just like people, there are some not as fantastic VCs out there. Let me take a pause, see if folks have questions. We have had a larger audience. Our numbers have grown by 10%. At this rate, we'll hit 1,000 people in another hour. We're not going to go for an hour, guys. We're going to go till 11 a.m. PST, another 14 minutes. So going once, going twice. I can barely see people on video, so I don't know if you're all sleeping or ignoring me. All right, I will continue with another topic then. So let's talk about fundraising, which is a topic that comes often. It's probably the single most popular topic. As VCs, we do have a disproportionate view on fundraising. I mean, I see about 5 or 6 decks a day, every day, and I've been doing it for years. I look at about 1,000 companies a year, and I will end up investing in maybe 2 or 3. So there is a asymmetry of information and an asymmetry of experience between entrepreneurs and VCs. There are some entrepreneurs out there who have been VCs or who are super savvy, but in general, you will be facing folks who know a lot more about the game that you're playing. And fundraising is a game in many ways, but it is a game with rules. And a game with rules means you can understand them and you can actually win with those rules. And one of the rules is that you want to, as an entrepreneur, as much as possible, run the process. Don't let the market necessarily push you around. Like, run your own fundraising process. The way you do that is the way I recommend. Have a spreadsheet. List out all the investors you want to talk to. List out 100 names there. Don't talk to those 100 names. You'll go crazy. You don't want to deal with 100 people like me. But prioritize them and make sure that you're talking to an X number at any given time. Maybe it's 5. 5 is a pretty good number. If any one conversation is kind of slowing down, up-level another conversation. If any one conversation is going really well, make sure that the other guys know about this and tell them, hey, look, we are getting very close to a term sheet. We have a term sheet. We're about to sign a term sheet, right? Like, you want to create momentum. You want to create a sense of urgency. And you want to run a process that is a few months long, not a few years. In the average fundraise is about, call it 1 to 3 years. Although with COVID, we have seen that the processes have been taking a little bit longer. We have seen more processes taking closer to 3 to 4 months. So budget for that. And what I recommend is, don't run a process when you have 3 months of cash left. If you have 3 months only, you will be forced to accept lower terms because you're more desperate. At the very least, you should have 6 months. Ideally, maybe a little bit more. And you, as much as possible, want to make sure that you get a lead, ideally 99% of the time, because once you get a lead, you can tell everybody, look, we have somebody who has set the terms of the round. Now it's a matter of filling up the round. Otherwise, you will be going to many conversations, and everybody will tell you, yeah, this sounds great. Keep us in touch. Keep us in loop. Tell us when you have it defined, right? Like, nobody will have an incentive to say no, and you will not get a yes until you have a lead defined most of the time. So I hope some of these tips help. Let me see the question from Raphael. Some examples of indicators to look out to filter out poor VCs apart from Crunchbase profile. Well, most VCs, in fact, I would argue almost all VCs are VCs because they're driven, because they're smart, and because they have worked hard. You don't get to be a VC otherwise. It's many of the same traits as an entrepreneur. The difference is a VC is not necessarily an expert in your business. Some of them may know a lot, but most of them won't. Think of them as very smart people who are sometimes a mile wide and an inch deep. So you may have to educate them. And in the process of educating them, if you notice undue arrogance or undue statements with no data backing them, it probably tells you that this VC is maybe full of themselves. So I would caution that. There is a little bit, I think VCs are entrepreneurs in a slightly different way. Like, entrepreneurs manage risk within a company and have many initiatives that they tackle. VCs manage a portfolio and many projects within that portfolio. It is actually a very similar skill set, with one key difference, which is an entrepreneur focuses on running one company and getting their hands dirty in one company. A VC acts much more like a coach working across many entrepreneurs. But I think the human element is a good indication. Then the other one is just the fund structure, right? Like, you may be looking for a 10 million check, and this VC may be fantastic, but may only be able to write a 1 million check. Well, that's not going to work, right? But if you really like that VC, you can find out a way to still have that person involved. So the poor fit comes from the personality, the track record, and the fund structure, the fund size. And some of this is easily diligenceable just by Googling. And some of it is only diligenceable if you talk to them. If you are very serious with a VC, ask them what are examples of things that they have done wrong, or ask them for references even. I think it's fair to ask for a reference. They will most likely give you a positive reference. Most people only give out positive references, but if you talk to a positive reference, I think it's as crucial to hear what they have to say than what they don't say. Like, if you ask the question, does this VC prefer that I go fast, or does this VC prefer that I go deep, right? Like deep as in go very detail oriented. They're both good answers, but it will tell you the kind of mindset that this person has. Like they prefer that you execute fast or that you execute thoroughly. They're very both good answers. So I encourage people to ask questions like that, where there's no necessarily a judgment value, but it will highlight to you the mode in which a particular person works. So we are coming up to the hour. I want to make sure if folks have other questions, shoot it now or remain in silence till the next session that you will have, that Denise will organize. So how do VCs consider solo entrepreneurs? Look, the data shows that overwhelmingly that co-founders have better successes. You can look up at a report that I think First Round published that the vast majority of companies are two founders, and then there's a long tail of 3, 4, 5, 6 founders. There are companies out there that have been very successful with 6 founders, LinkedIn as an example. But you look at some of the bigger successes today, Microsoft was essentially 2 founders. Apple was effectively 2 founders. Google was effectively 2 founders. Facebook was about 4 with 1 really big founder. There are counterexamples for every rule. Amazon was effectively 1 founder. He had a first employee who was quasi-founder, but he never had the title. So in general, VCs like having co-founders because it de-risks a bit. It allows them to have conviction that you were able to convince at least one person to take the bet, and that you have somebody else who you can debate with, that you can fight the good fight. I think it's better for founders also. I always wanted to have a co-founder. I've always had co-founders in whatever businesses I've started, whatever nonprofits I've started, whatever venture capital fund that I've started. I think it gives you more energy if you have the right founder. That said, if you are a solo founder, then just prove it to the VC that you will be able to overcome whatever gaps there are. You'll be able to hire still good people, that you're still very driven, and that you are a founder, solo founder by choice, rather than a solo founder by chance, because nobody else wanted to work with you, right? Make sure that they recognize that you're a solo founder by choice. I don't think there's anything wrong in being a solo founder. It's just that you will have to justify it a little bit more. So last minute questions per Denise's question. Yuichiro is asking, can you explain about relationships between VCs, generally friendly or competitive, hostile sometimes? Yes, yes and no to all of the above. I do also have a great article on this if you go through my LinkedIn. In general, early stage tends to be more cooperative and late stage tends to be more competitive. Early stage is all about de-risking something that has a lot of risk. So we, as well as almost every early stage investor you'll talk to, will tell you, we want another VC fund in the deal, because we know that there's another fund with their network, with their expertise, that can help the company, that can come to us. Like it's a good idea to have at least another VC fund for you as an entrepreneur. And relationships between VCs can be super strong. I mean, I have VCs that I've been working with and sharing deals with for 10 years. We just did a deal that we committed to investing first, and then we brought in another VC and gave them a bigger portion because they were a bigger fund. So they put in more money. So I think it can be super friendly. Where it gets more competitive increasingly is when you're raising a Series B or a Series C or D, when the funds are competing to see, okay, this startup is starting to take off, or it has already taken off. I want to own 20% of it. I want to own 30% of it. And there's only room for one person, one fund to do that. So the multi-stage funds especially, they will compete with each other ferociously. It's very rare for 2 multi-stage funds to cooperate in a very hot deal. Google is famously a counterexample to that. Sequoia and Kleiner divided the Series A equally, which was 25 million, in a really hot deal. And that's it. Google never raised any more money. So Sequoia and Kleiner did fantastic. That is a little bit more of the exception than the rule. So don't underestimate how much VCs talk to each other. I talk to another VC at least once a day, sometimes more than once a day. Sometimes they are my co-investors. Sometimes they are people that I want to send deals to. Sometimes they're people I want deals from. And sometimes they're people we're helping with diligence. Sometimes they're people that we are helping with diligence. I mean, we talk to each other all the time. And it's at the end of the day, a small group of people. There's maybe 4,000 VCs in Silicon Valley. That's it. So I'll take these last questions and we'll call it a day, since I do have a call with my own investor in 2 minutes. So I'll try to do this a little quickly in respect to all of you. So Erica's will be the last question. So Anubhav is asking, do VCs only look for entrepreneurs from their home country or would they go international? Depends. There are VCs with all kinds of models. We invest in VCs, in entrepreneurs based in US and Canada. They can be from any country. I'm born and raised in Brazil, by the way. So I came here to the US as an adult, and I have a disproportionate network among Brazilians and Indians, since I'm also Indian by my roots and by another citizenship I have. So it depends. There are some VCs out there who explicitly focus on outside of their home market, but that's more the exception. Vinesh asks, can you please expand on the solo founder choice, perhaps an example of a reason for being a solo founder that might be convincing to you? Sure, the reason would be if you have some disproportionate advantage. If you as a solo founder say, I am the world expert in this particular field, and I know I can do it, there's nobody else who can do it. And by the way, I don't necessarily need to give out enough founder shares to somebody else, but I will bring in a bunch of folks to help execute with me. That is a convincing reason. It is a little bit on the rarer side. In our portfolio, we only have one solo founder out of 14. Why is the answer to life 42? Babu, that's just from a book, The Hitchhiker's Guide to the Galaxy. You got to read that book if you haven't. Oh, and Erica just answered that. So with that, I will end here. I wanted to just thank you again all for being here with me today, for indulging me, and to Silicon Valley Forum for putting a great forum here and for having me. So thank you all.
Thank you so much, Amit. We really appreciate your time. And thank you everyone for joining us today. I have to say that I have been doing this for over 10 years and I've learned so much from Amit today. So really appreciate that. And finally, would like to thank our wonderful partners at Hopkins and Carley. This event series would not be happening without them. So Brendan, thank you so much to you and your team. Thank you to all our attendees who showed up today. And we hope to see you at our next session on December 3rd. So everyone have a wonderful day. Thank you.